We note that the UK stock market has been an underperformer, that sterling has weakened against most of its major counterparts since the Brexit referendum. In our opinion, if you're a US dollar-based investor, UK stocks look, in dollar terms, 20% cheap against global counterparts. Should the Brexit dilemma be resolved anytime soon, I think that may prove to be the catalyst for some of that value to be unlocked. When we look at our leading indicators of economic activity through 2019, they've slowed markedly. Looking at the detail, this is largely down to manufacturing. Consumers globally, by and large, have held up well. There hasn't been a huge problem with final demand. Corporate sector built up excess inventory, in our opinion, at the end of 2018, early 2019, ahead of what they expected to be huge disruptions from the global trade negotiations. Where we go from here is going to be dependent on, does that economic activity from the manufacturing sector continue to slow and impact the consumer, or might we see that having drawn down their inventories, that we get industrial activity and manufacturing back to more normal levels of production that will stabilise economic growth. Our biases remain, as they have been for a little while, that this is a mid-cycle pause for the manufacturing sector, that having drawn down their inventories, we will get production back up to more normal levels. When we look at data, for instance, with semiconductors, an early stage indicator, we do see that we got a big increase in inventories, a big fall, and we are now starting to see new billings increase for the first time. So whilst our economic lead indicators have been weak, actually the economy and markets have been receiving their medicine. Central banks have been loosening monetary conditions, both with lower interest rates and quantitative easings, and we see governments doing likewise, loosening their purse strings with a slightly looser fiscal policy everywhere, including the UK. This has helped support the bond market, leading to lower yields, and has helped maintain higher valuations on growth or long duration stocks within the equity market. It means that we're not unconstructive about the outlook for equities. Our preferences, however, are changing. We're moving away from the United States towards Europe, towards Japan, and dare I say it, the UK, a serial underperformer over recent years. Why? Well, we're starting to have a preference for value over growth. Growth stocks, those that their earnings are all out there in the future somewhere, have been supported by falling bond yields. Value companies, however, we think are under-owned. People have remained nervous about economic activity, and if we're half right about the prospects for the global economy, we think that value as a style will see outperformance in 2020, and we are starting to position for that.